Man, so Trump, man, he is getting after it. He is tackling housing affordability. What's your take on all this, with Trump and mortgage-backed securities? What's going on? Explain it.
Well, I think, I want to give Lance Lambert a shout out because he actually indicated at the end of the year that he expected multiple announcements to come. Uh,
Yeah.
I'm going to guess the press, which Lance is included in, kind of
Yeah.
got some whispers so they can create some articles. So it was good insight that these things were coming. I think Trump, and we should talk about both of them. So far, we've gotten two announcements that are aimed at making housing more affordable. I suspect, and this is where the fun comes in, I suspect there's probably 3 to 5 more coming. I think Trump is a promoter, and I think he's kind of has a drumbeat of like one a day kind of thing. And I don't know if it'll be one a day or 3 a week or whatever it will be. He did say that expect more details at a presentation. I think it's in Davos in 2 weeks, so a lot more coming in January. But again, I think it's very clear in the Trump administration is going after affordability and housing affordability specifically. I also think this is all about the midterm elections, right? A lot of the things that we're looking at are because they want to win the midterm elections, right? If Trump loses the House or the Senate, he's a lame duck for 2 years, and he clearly doesn't want that. So they did two things. They announced, basically institutions should get out of the single family housing, right? They should stop buying and owning, right? People live in houses, not corporations, I think was the quote. And then he did the mortgage-backed securities. I think one of those is completely symbolic and will mean very little. And I think the other is, frankly, exactly what I told you was coming. And if you go back and look at some of my wrap-up videos from 2025, I suspected live, probably in one of our conversations, like, would the Fed, would the Treasury, would somebody in government step up and buy mortgage-backed securities? Because it was easy for me to tie it together because, what do we talk about all the time? What percentage of the country has mortgage rates below 3, below 4, below 5? Now, if you step back and you ask yourself, how did it get there? Well, it was because the Fed bought mortgage-backed securities. It's an easy leap to make. Right. So I was like, I always thought, like, who could President Trump get to buy? Like, who could President Trump just wave his magic wand and buy mortgage-backed securities? And it turns out the initial one is Fannie and Freddie. Right. So we'll talk about that in a minute. So let's talk about the one that I think will ultimately be symbolic, but is frankly news to, good news to a lot of people. And that is getting institutions out of single family homes.
Yep.
There's all kinds of memes and stories about, they always say BlackRock, which is so silly because BlackRock's not in housing. It's Blackstone, right? Blackstone owns like 57,000 homes, but that's neither here nor there. But yeah, there are some areas of the country. I think Atlanta and Jacksonville are the two cities most concentrated. Again, Lance has these details. I'm just repeating them. In Atlanta, 25% of the available rental single-family homes are owned by institutions. That's crazy. That's 1 in 4.
Yeah.
If you step back and say, how many single-family homes do institutions own in Atlanta of all kinds? The answer is 4%.
Right.
That's obviously much smaller than 25%, but I would argue 4% is still a wild and crazy number. That's just wild. Like, that's like 1 in 25. Like, you go down the street, 1 in 25 homes is owned by an institution. That's crazy.
Yeah.
So, I guess the thing that I took away from that announcement, and again, we have no details. We have one social media post to go by, is Trump said institutions can buy no more. And that's actually, that word more is an important point, because the question I had immediately was, okay, great. So they can't buy, but are you making them forced sellers? And by saying you can't buy anymore, you are not making them forced sellers, right? Making them forced sellers in Atlanta, for example, would crash Atlanta's home prices.
Yep.
Just think about it. They own 4% of the market. If you have to list 4% of the market overnight, you're going to screw the market, right? So again, it doesn't sound like he's going to force them to sell this. It's basically, hey, you're grandfathered in under the old rules, but we have new rules, play by the new rules. So I think the keeping institutions out of single family homes is a wonderful, tremendous headline. He could say it at every speech. He can have a rallying cry and get the masses all riled up and say, hey, I'm fighting for the little guy and blah, 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 blah.
Right.
But it's going to mean practically nothing, frankly.
Yeah.
But it could help him win the election. So, I would argue, because I can only imagine how many times that will be quoted between now and November, right? I kicked the institutions out. I did this. I did that. I'm here for you. Get the American dream, blah, blah, blah. But if you're looking for it to actually impact prices, it's not going to happen. Now, if you really look back at supply and demand, it could dent some demand, right? If you say you can't buy anymore, that's just some demand that fell off. Now, in reality, if you really study the market like I have, the institutional buyers are not the same institutional buyers from 2010. In 2010, I ran into institutional buyers.
Yep.
I was running a process where every Monday, the Fresno MLS would get a tape. They called it a tape. I don't know if it was a tape or digital, but they called it a tape of the new foreclosures. I would go through by 9 or 10 in the morning and figure out which ones I wanted to offer 19% below list price. Why 19? Because 19 they said yes and 20 they said no. And I was running that process for almost 2 years, every Monday.
Yep.
And we were picking up stuff left, right, and center. It was amazing. And then one day, nothing showed up.
Right.
And then the next week, nothing showed up. So of course I go and I call people, and they basically say guys from Wall Street are buying everything at list price. Right. That was my first introduction to the funds. And I'm like, those guys are morons. They're idiots. They're not getting 19% discounts like I was. And little did I know, they're like, screw the discount. We just want to own these things.
Right.
And they won. They cashed out big. But that is that I would call that scatter. Wall Street was buying stuff in scatter. They were buying everything. Good, bad, left, right, indifferent, didn't matter. They bought everything. If you look at what funds are doing today, they're actually doing what I would call build for rent. They're basically doing horizontal apartments, right? What I mean by that is they're buying a plot of land, they're paying some builder, and they're saying, hey, build me 100 homes. So instead of building an apartment building that goes up with 100 doors, they're doing it this way. And, so they're not doing the same things they used to do, right? They're not buying scattered. They're buying very focused, on purpose, and the like. And it's going to be very interesting. And I just read an article from Bill Pulte. It sounds like they may come after that as well. Right. Because it's all unclear what is getting out of institutional single family homes means. So there certainly might be less demand, but I don't think we're going to be forced sellers. That's the first one.
Yeah, it's interesting that completely agree with you. It is absolutely a big headline. It was very viral all over social media. All of our friends were all making videos.
Yeah.
I was busy this week. I didn't make a video. It was like, I'm going to do a video on this. Maybe I will here the next week. But point being is that I think it was more sizzle than it is actually, is it going to move the needle on the market? I don't think so.
Maybe Atlanta, maybe Jacksonville, right? Any market that has high concentration, but if you're not in those places, it's a nothing burger. It's just a flat out nothing. Yeah.
And I think too, that if you look at really private equity, institutional buyers, the real game, I was very much feet on the street and a part of that. Invitation Homes, which was, of course, Blackstone. And then, of course, the guys that I did a lot of acquisition and did a lot of work with when I was at Fannie and Freddie was with Waypoint. And these guys started off from a small little brokerage in Santa Rosa to basically they were the top 3 floors of a high rise in downtown Oakland overlooking over Lake Merritt. It was like one floor was just accounting, one floor was acquisition, and then one floor was like C-suite type, leadership. Yeah. And it was interesting. You'll like this, Michael. Every time I would go in there in the office, I would see there would be a bunch of people in this beautiful glass conference room. And I could see the PowerPoint going, and I'm going, what's going on there? And they're going, oh, we're raising another $100 million. And they would do these tranches of $25 million, $25 million tranches, all with different level, names, same name, acquisition fund 1, acquisition fund 2, acquisition. All of that ended up rolling into Starwood. So the guy you talk about,
Starwood.
Billionaire Barry?
Billionaire Barry. Yeah.
Starwood. So Starwood at Colony Homes, Starwood. And even now, I think part of that portfolio is all with Blackstone. So, but it's interesting that they don't have their foot on the gas because they're was net sellers.
Yeah. Today they're net sellers. Yeah.
It was a moment in time from 2010 to about 2014. It made sense. And honestly, and I got to say this, if we didn't have institutional buyers in 2010, the U.S. housing market would have been a complete bloodbath. You know what I mean? There was not enough demand or not enough Michael Zuber, Olivia.
Oh, shit. The banks weren't lending, dude. The banks weren't lending. That's what people don't realize, that last year in 2010, it kept going down because, I mean, I had to go get hard money at 12%.
Right.
I mean, that's the kind of lending that was there. So yeah, Wall Street, at the encouragement of Paulson, I think his name was, really saved the housing market. They put a floor into the market immediately.
Yeah, and it was smart. They stabilized the market and they stopped the free fall. And like you said, then it's that 19%. All of a sudden, they're like, "Hey, we don't care because we have a 5 to 7 year.
We have a 10-year exactly. We have a 10-year horizon exactly.
Yeah, they're not looking at it. This is great, man. I love that. Behind the music, I like that we get to talk about because we were there. So
we were there. That's right.
Yeah, we were there. Let's talk about
I think we have to hit the 200 billion now.
Yeah, right? No, that's where I'm going. So 200 billion. Trump advocates and says, "Hey, we have 200 billion. Here's the question I have for you, though. Talk about it, but then also mortgage-backed securities is like a 15, 16 trillion dollar market. So how does 200 billion, how does it move the needle? Talk about the 200 billion.
Yeah. So again, I think you're absolutely right. I think your term for the first one, sizzle, is right. And again, sizzle plays in the media, so it's a good play. But here's the stake. And again, if you've been watching the interest rate market like I do on a daily basis, you might have been asking yourself, why did interest rates fall in the last 90 days? Right? Because if you were not paying attention, and I said it on the show probably 20 times, rates seem to be falling like a feather. And there was always kind of questions like, why is that? Like, what is going on? And, if you go back and you look at Fannie and Freddie, what happened is Fannie and Freddie quietly bought $100 billion in mortgage-backed securities. They own that now. This is not future. They already did it. They got them.
Right.
So I think what a lot of people missed is MBS was already being bought. I think what Trump is doing now is he's realized under conservatorship that he can legally, ask them to, I think the maximum is 450 billion. Right now they have about 125 billion.
Okay.
And here's the wrinkle. This is what people don't see is coming. So first off, you absolutely know they're going to go to the max, whatever the max is. If the max is 400, they're going there. And I read an article this morning that said in order to raise that 400 billion, you basically got to get like 3 Trump appointees to agree. And I'm like, well, guess what happened? They're going to take that from 400 billion to $1 trillion.
Yeah.
Because, Trump's going to make 3 phone calls and say, thou shalt do. And they're going to go, yes, sir. So I think this is just the beginning. And I think he's saving the ammo because he wants to keep hitting the drumbeat. Okay, great. We have 100 billion. We're 6.15 today. We go spend another 200 or 300 and now we're 599. And then in March or April, whenever that, those billions get consumed, he's going to go, dude, we're going to double it. We're going to go to 800. Trump's a promoter, right? He's just trying to grab the headlines and grab interest and this is his focus. His focus is housing affordability. So this is all a game. These are all chess pieces.
Yeah.
And now for your real question, how meaningful will a couple 100 billion be? It will be meaningful, but it will be consumed relatively quickly, right? I think my dates I just said are fairly accurate. It's like March or April.
Yeah.
But it will be meaningful. I would expect mortgage rates. I mean, dude, they could touch that 5.99 for
Yeah.
sure. This is not 4%. This is, and again, I'm glad I have receipts, right? You and I
Yes.
talked about what, like, Zuber, what do you think interest rates will be next year? And I'm like, 5.8, 5.9,
Yep.
sub 6. And the reason I said that, even though everybody else was saying 6.2, was I fully expected, Trump to pull a magic hat and buy MBS. This is like, people are asking me now, like, hey, Zuber, where are you going to take your interest rate forecast now? And I'm like, nowhere. This is what I expected, right?
Yep.
I'm not going lower because I expected, MBS to be bought by somebody in the government. I didn't guess Fannie and Freddie. I thought Treasury maybe, or the Fed or somebody. But, hey, we got Fannie and Freddie stepping up first. And, who knows? Treasury might be next. And, by the middle of the year, a new Fed president, maybe they buy $1 trillion. And yeah, so I think mortgage rates, I'm not changing my interest rate forecast. We might touch 5.8. I think we average 5.99, something with a 5 handle. And yeah, this will be meaningful. And again, it's entirely symbolic. I mean, if you do the math, if you break down and do the math on a 6.2 versus a 5.99, the payment is not materially different, but it is really psychologically different.
Yep.
And again, we are playing a game of consumer confidence.
Yes.
And consumers feel better at 5.99. You can just go back and look at the history. We hit 5.99. I think it was late 23.
Yep.
And activity spiked. And then,
Yep.
Rates went up and, it was over in a flash, but it did happen. And I think we're heading there. And I think we're heading there in the spring selling season. So if you get a 5.99 in the spring selling season, we're going to make last year's numbers look pretty crazy. So I think the first one, again, blocking institution is sizzle, but sexy and loud. I think buying MBS is market moving. It moves the needle for sure.
100%. I love it. Something we always talk about every week. I love it. Let's keep the show going. So let's talk about Convoy Home Loans.
It's funny. People know that Convoy's on my channel once a week, and their founders, Dustin and Jonathan, reached out to me yesterday as soon as this announcement came out about them buying MBS. Because again, they work with Wall Street. This is what they do, right? They do loans and they feed this beast. And they asked if we could do an emergency call. So 9 a.m. today, Pacific, 9 a.m. Pacific. So I don't know, an hour and 13 minutes from now, I'm going to go live again, which I never, ever do. But I'm going to go live with Convoy, and we're going to take questions from the audience. Like, what do you want to know? What's your understanding? We're going to pontificate a little, make some guesses about the future, because I think it's that important. I think the blocking of institutions is sizzle, and frankly, there's no meat on the bone or very little. But buying MBS could be game changing because it could just be the start. And I thought it was important enough where I change my normal schedule and we do an emergency session with Convoy Home Loan. So, 9 a.m. We're going back. Yeah, we're going back. Yep, coming on live.
I love it. I will actually be working, but I'm going to be in the comments asking my questions. So, or I'll text you my questions so that I can hear the
That
replay.
works. That works.
I love it. I love it. So let's keep going. Let's talk about what's next. And how do you see, you've been calling this literally month by month. I always feel like you've never been wrong in the 5 years we've been doing the show. You've just been early.
I've been early a couple of times. Yeah.
You've been early, but it's very rare that you're quote unquote wrong. You don't miss. You might be early, what you call a swing and a miss. Talk about what's next.
Well, I think that's the question. And again, I communicated with Lance Lambert before this call. So again, why did I do that? Because again, Lance kind of gave us a sneak peek at the end of Q4, what was coming. Nobody knew I didn't know what Lance meant when he sent that tweet out, but now I've already seen 2 announcements, and he's, oh, by the way, yesterday he told me more is coming, but he can't tell me what it is, obviously, but he said more is coming. So I'm just going to wild ass guess. Right. So, I think there will be an announcement about a 50-year mortgage. I do think there will be some caveats, like first-time home buyers only or something like that.
Yeah.
I don't think you can throw it out there to the masses because it doesn't give you the juice. But if you do a 50-year mortgage for first-time home buyers and this is an important one, and you have them match the interest rate of the 30-year, you could unlock a lot. Because again, what people don't understand about the 50-year, just giving how bonds are priced, the 50-year mortgage should normally carry a higher interest rate because it's a longer term.
Right.
However, if they wanted, they could come in with a program that says for first-time home buyers only, and they'll have to define what that is.
Sure.
We will give you a 50-year mortgage at the rate of a 30-year, and we'll pay the difference, right? In theory, the government would pay the 2 points or whatever it takes to get the interest rates to match. But something like that. I think there has to be something coming aimed at first-time home buyers. I really do. Something. So I expect something like that to come. I will say that the next one is a hope. Because I think a lot of things that are sexy and quick are all demand oriented.
Correct.
And I've already warned about it. Hey, if you goose too much demand, you don't get what you really want. Yeah. It's not a good outcome for anybody. It feels good in the moment, but long-term it sucks. So a hope of mine is they come up with some kind of initiative to incent, because again, the federal government can't do this. It's all state level and city level, but they can create a bucket of money that says, hey, if you want to create some entry-level housing, we will give you, I don't know, pick a number, $10,000 credit per home. And I think you have to define what an entry-level housing is. It's 950 square feet. It's 1,100 square feet. It's something like that. Because that I was asked at the original Resi Day, what would be my magic wand? It would be that we would go back and build entry-level housing. It's just not profitable today, right? The average home, I don't remember the exact stack, but I think at its peak, the new homes were averaging 2,300 square feet. That's not entry level, right? I think today they're 2,100, but they should be like 1,200. Right? So my hope, and again, this is just a hope because I'm hoping putting good karma in the universe, comes back. So there's something around supply. There has to be something around supply. If all of this is a dog and pony show that just gooses demand, the only people that are going to get rich are guys like you and me who already own stuff. And we don't need that, right? We need to help the masses. So I think there has to be something first-time home buyer. I'm hoping there's something supply. And then I'll just throw this last one out. Again, if you're looking to unlock supply, you could create some kind of tax incentive for mom and pop investors. What might that look like? Yeah, what might that look like? All right, so until Trump is out of office in 2028, for example, or 29, or whatever that is, you could say something like, if you sell a rental property to a first-time home buyer, we waive capital gains, or we cut capital gains in half, or depreciation recapture is you could do lots of things to encourage the people that currently own entry-level housing, like me, to think about selling.
Yep.
So that would be the last one I would throw out. That might be fun.
That one is 100% supply, and that people are setting on, but they don't want to pay the taxes. And just like in the Clinton administration, where they did 250,000 single, 500,000 for married, they did the exemption for 2-year owner occupant. They could do a similar thing for 100%, like, and then maybe cap it based on median value or first time buyer certification, something like that, or have a cap on the sales price. Makes total sense. To me, that unlocks supply big time.
I agree. I mean, as a guy who owns some units, if you told me for the next 2 years, I could sell a couple of my homes tax-free, I guarantee you I would sell a couple.
And you think about too, maybe they put a cap on it, no more than 2 per calendar year or something like that. That could even be sexy, or even 1 per year for up to, X amount.
Whatever.
So,
it's just how much supply do you want? So those are all my hopes. I have no idea. I have no inside information. This is just one guy throwing a wish list out there, but those are what they are.
And no depreciation recapture.
Yeah, that'd be fun. That'd be fun.
That's the better one. Okay, so let's keep going. So let's talk about jobs. What happened this week, and how do you see jobs, the JOLT report, ADP, non-farm payroll? What happened this week with job.
Yeah. So we are back to the standard of getting 3 jobs reports the first week of a month, right? We had the government shutdown and stuff was all screwy for a long time. So we're finally back on cadence. So we'll go through in the order that they came out. JOLTS report. I don't remember the exact number, but I think they were expected to be 7.6 million and they came in under 7.2. So we lost something like 400,000 job openings, which is a huge miss, which is a sign that the low hire, low fire market is continuing. And I'm arguing the labor market's getting worse, not better. I mean, that's my thesis in Q1 of 25 is the labor market's worse than the top line numbers. And at least by the JOLTS report, I was vindicated in my opinion, but again, lots more data to come, but that was the JOLTS report. Then ADP. ADP was expected to come in, I believe, at 75 or maybe 77,000 jobs were created. It came in at 61. So again, it came in under. It really pointed to a white collar problem because I think it was information systems and business services that saw big drops in like actually negative numbers. And so again, the ADP report was weak but not catastrophic, if that makes sense.
Yep.
And then the one that came out this morning, and again, I have no problem admitting I got one of these variables wrong.
Okay.
So again, a swing and a miss. But the jobs addition was 50,000, and it was expected to be 70. So again, I think it was 51,000. So again, labor market is not adding jobs. But on the good side, last month the unemployment rate was reported at 4.6. It was 4.56 to be exact. It was revised to 4.5. Why is that important? Well, frankly, it makes the Fed look better, right? The Fed said in their dot plot they did not expect the unemployment rate to get above 4.5. So that 4.6, which I gave them a hard time about, is now been erased. So it's only 4.5. So they're okay. And this month, the unemployment rate fell to 4.4. So I was afraid it would go up because, again, the thing that I am concerned about that I don't think a lot of people are talking about is the participation rate. Mm. The participation rate dropped last year, which made unemployment look better than it was.
Yeah.
It is my belief that in Q1, Q2, participation rate will go up. And then just because of math, the unemployment rate will rise. That clearly did not occur in January or occur in December, reported in January. But my concern is still valid. I think it's still correct. Again, to your earlier point, maybe I'm a month or two early. But I'm not less concerned today. I'm equally, if not more concerned. Yeah.
Jobs is a big issue. Again, it's something that's going to move the needle with the Fed, rate cuts, all of it. Talk about participation rate, though. Unpack that. Just what does that mean? Does that mean people not filing or falling off on the back end?
It just basically means how many people are actively looking for work, basically.
Got it.
Right.
Okay.
So one of the reasons participation rate fell last year is we imported 2 million or 10 million or whatever illegal aliens, and that just increased the denominator. So again, when you do that, the rate, the number on the outside falls. Now that people have been deported, last time I heard 600,000, there's been like 1.5 million or 2 million self-deport. So we just extracted 2.5 million people from that number. So I'm like, holy shit, this participation rate's going to jump. And then because of how the participation rate works in unemployment, it's going to force unemployment. My fear is by June, July, August, unemployment's 5%.
Wow.
Not because the labor market breaks materially, but just because the participation rate goes back to the mean, right? There's this thing called reversion to the mean, and we artificially pushed participation rate down, and we're going to pay the price for that coming back. And I don't think anybody's talking about that.
Dude, you're so smart. I'm going to have to go back and rewatch that last 30-second piece, dude. I love it. We are lucky to have you. So let's talk about, the Fed. Is there going to be a rate cut in January? What do you see?
No chance. Zero chance. Why would they cut? There's no reason to cut. Nope.
And then, so how do you see the Fed just kind of look into the next 3 to 6 months? How does Jerome Powell finish out? Right, he's done in May.
Yeah. So again, January cuts 0% chance. Zero.
Okay.
Zero. The next meeting is March. I believe there are 2 CPI and 2 jobs reports before that.
Okay.
My fear is I will be proven right by March, but I don't know that it will be enough to make the Fed move. So my first cut is April.
Okay.
I believe, and if you're following my writings on LinkedIn or school, I believe the Fed's going to be forced to cut 5 times this year.
Mm.
And the first one's April. And the Fed today thinks they're only cut once or twice. So my fears of the job market going to 5% unemployment and frankly inflation falling faster than expected means the Fed's going to cut aggressively. So I expect 4 to 5 cuts this year.
4 to 5 cuts this year. The job market is going to shift. Those numbers, that's obviously going to shift. And then, of course, we've got Trump with mortgage-backed securities. So potentially also that job market is going to soften up the 10-year as well, right? So it would.
You would think, yeah. Yeah, you would think. You would think an unemployment rate of 5% would dramatically impact. Yeah, you would think. Yep.
So let's talk about just real quick. I think it's important for the viewer to know. I think you'll agree with this. There's no way in we're not going to 4% or 3% or 4.5% mortgage rates. There's no way like that was a unicorn in time based on a global disaster, and that probably a once in a lifetime, hopefully a once in a lifetime global disaster. You're not going to see 2, 3, 4%. So stop holding your breath if you have that mindset thinking that that's ever going to happen again. But is it possible that with the jobs market shifting that we get to maybe 5.5?
Well, that's interesting. So again, so I'm going to split hairs, kind of yes and no, but let me tell you how I get there.
Play with it.
So again, my thinking hasn't changed. My call for 2026 is we'll touch a low of 5.8 with the average being 5.99, right? My opinion hasn't changed. I said that because of MBS. Looks like I'm going to be right. However, let's step back and ask the bigger question. Can you get 5.5? The answer is going to be yes. If you put 20% down, have good credit, maybe put 25% down, maybe do a point, there are going to be plenty of people that get 5.5. I will even go out on a limb and say some people, if they pay 1.5, maybe 2 points, maybe FHA, I don't know, something, there'll be some people that get a 4 handle, but you're going to pay for that. Right. That's not going to be the average. The average is not going to be 4.99. But if you have an average of like if you touch 5.8, that means some people are getting 4.99. Right. So again, will some people get something with a high 4? Absolutely. Will most people? No chance. But some might.
Buy it down.
Yeah.
Yep. Buy a new home build. I know a guy that's got a 4.99.
Yeah. I know a guy too.
You like that? So here we go. Let's talk about GDP Q4. What happened?
Dude, this one's going to shock people. So again, I'm trying to educate people on the daily financial news. We talked about Q3 GDP. We talked about why it was a game changer, and it was the trade imbalance. And the reason that's important is imports subtract from GDP. It's just a math is math, people. You can get mad all you want, but you're getting mad at math. So it's mind-boggling that people go, oh, this stuff's all manipulated. I'm like, dude, it's fucking math. What are you talking about?
Right.
So earlier this week, I forget what day it was, the trade deficit came in at record lows, like 29 billion or something crazy. And just the other day, it was 130. So what does that mean? And again, I have receipts. As soon as I saw that number, I sent out a tweet, and I think I did it on the Daily Financial News. I'm like, guys, Q4 GDP is going to be over 5%. And people thought I was crazy.
Yeah.
And I'm like, no, dude, it's fucking math.
Right.
If imports have collapsed that much, it's just math.
Right.
And sure enough, yesterday, Q4 GDP is forecast to be 5.4%.
Yeah.
I told you.
Yeah.
It's just math. And people are losing their mind. So it's crazy.
You called again. You've been talking about that for several weeks, a month.
I did.
This last month, you talked about it. I love it. So let's talk about trueflation. What is inflation versus trueflation?
So again, we get CPI, PCE, PPI from the government. They've essentially been using the same outdated data collection methods for decades, and they're always backwards looking. Trueflation is a private company that takes in over 1,000 data sources, hundreds of millions of data points daily, or at least weekdays, so Monday through Friday. And it's called real-time inflation. It's updated every day. Why is that important? Well, I've been railing against the machine.
Yep.
The easiest example is Shelter. Shelter in the last reading was reported at 3.6%. It is actually -1. So there's a 4.6% delta, mistake, error, whatever the hell you want to call it. And, oh, by the way, Shelter makes up 32% of inflation. So you have the largest single component overreported by 4.6% inside CPE, PCE, the like. Trueflation don't play that shit. It's updated real time. And Trueflation, as of this morning, has CPI at 1.91.
Wow.
And PCE at 2.05. The Fed is 1. And you know what Trueflation says? Big old asterisks. Why is inflation falling? Housing cooling rapidly.
Wow.
I told you.
Nailed it. I love it. I love it. Nailed it. And what a great way for Jerome Powell. Man, talk about a guy that, I mean, he already had gray hair, but I would guess that, right? Like you think about this, his term had to be incredibly stressful this last 4 or 5 years. And for him to basically be at trueflation at 2%.
Yeah, it'll be interesting because he won't declare victory until May, right? He's guarding that reputation hard, which he should.
Yep.
But he's got to be smiling in the background. He's like, dude, I only got to get to May.
And you talk about political pressure, right? I mean, the guy, like, tremendous political pressure. So, man, wow, I love it. Do you want to let's talk about Vegas real quick. So here's the thing. I know that this is not a sales pitch.
Okay.
You're closing the cart, meaning that when he has his deadline, when Michael talks about stuff, he really means it. He's not just, oh, no, it's not hype. Like, oh, the 15th, no more tickets after that. Talk about the event.
Yeah, the event is, we got 6 days left. It's under a week. I'll be honest. I frankly thought we would sell 50 or 60 more tickets than we already have. Yeah. I thought there were a lot of people, and I still get texts from folks. I'm coming. Well, you got 6 days left to buy.
Yep.
And I don't think we're going to sell those last 50 tickets. Like in the last week, we only sold, I think, 3, which is good and bad, right? Because we had almost 250 people buy the first 6 weeks, which was way back in August and September. So I have a very loyal following, which is awesome. But I had assumed that once the calendar rolled to January and people were down to those 2 last weeks, that we would get a rush of buyers, and it just hasn't happened. Yeah. So I'll admit that that's disappointing, but it doesn't matter. If nobody else buys tickets and we just roll with 257 or 256 or whatever it is this morning, I'm down. It's more than last year. And, it's going to be an amazing event. But I will admit, I mean, I just live out loud. So I'm disappointed. I thought there'd be another 50 or 60 people that would get us to 300.
Yeah.
But it might not happen. If you want to come, you got 6 days, Eventbrite, and I hope to see you there. If not, no hard feelings, maybe next year. But yeah, it is a little for the first time. I'm disappointed that but again, we're already bigger than last year, which is cool. I just thought we'd get to 300, and we may not.
Yeah, I think too that talk about the guest, Jason Hartman.
Yeah, and Jason Hartman.
Chase Morby. Like, how could you not? This is the perfect economy for subject to creative financing, seller financing. I mean, you have the ultimate creative financing guy come and talk about the guest.
We've got some amazing headliners. Again, and we also got Rob Abasola from Bigger Pockets, right? We got Jason Hartman, Rob Abasola, Airbnb fame, Bigger Pockets fame, Pace Morby. But let's not sleep on the One Rental at a Time fans. right? I love all those headliners, but I like celebrating our family. We've got Brandon coming in talking about how he's doing infill ground up development. We've got Jared talking about co-living. We've got I got so many people. We've got Aaron coming in about raising money for a family mission project that they wanted to work on. We've got two legends from last year you guys wanted to see again. We've got Fred going to protect the mindset, make sure you're good. Fred's also giving time away. Lunch on day 2. He's going to take 4 one-on-one sessions. We got Dr. Jeff, who took me on my year-long health journey from 35 to sub 12.
Yep.
We're going to do a panel of questions. So, we're the headliners are great, but I think our family's even better. So
yeah, talk about so Jen and Jason.
Jen and Jason are coming.
Absolutely. I mean, talk about doing big things and having not only that, but the family of people that are there and the networking and all of it. Folks, don't sleep on, you absolutely need to be in the room. If you want to be there, if you have the ability to get there, get there. Yeah. But the cart is closing out. Yep. The cart is closing out. And did you see Jordan? Jordan wanted to be famous.
It's all right. Come on in, Jordan. That's right.
Yeah. I was like going to put him on my lap and have him talk about inflation. But anyway, so
there you go.
Folks, get yourself to the event. This is not a hype. Oh, we're selling out by the 15th. If you're going to be there, go to Eventbrite. The Eventbrite, you go to one rental at a time, buy your tickets. How much are the tickets?
I believe general admission is $299 and VIP is $699, I think.
Ridiculous. Ridiculous. $299 puts you in the room. And by the way, that's lunch, dinner, lunch.
And dessert. Right? And I'm doing a celebration on day 1. Yeah. So
and dessert.
Let's just say the $299 barely covers food. Just the food.
It's a break even. Yeah.
It's a break even. Yeah.
The whole event is not a big money making thing. It's a celebration. It's Mike's gift. It's Michael's gift to the community. So folks, get yourself there. Michael, let's do something fun today. I know you've got a few minutes. I do too. Yep. Let's stay on for another 10, 15 minutes. Let's go to the half hour if possible, if we have the ability. Let's take some questions. What kind of questions in the chat or comments?
All righty, folks. If you have to have some questions, put some questions in. I will scroll to the top and see if there's any questions. This should be fun. You have any questions for Ty or I? Oh, we have a super chat. I didn't even see it. What's this one? Oh, Josh, you're amazing, buddy. Always talk about money. Here we go. Josh says, let's go, Vegas, baby.
Yeah, love it, Josh.
I appreciate that. Let's see. Are there any questions? Again, put in questions. I will scroll to the bottom. Lots of people saying good morning. Good morning. Lots of people appreciating us. Hey, Sarah.
Put some of the people on the screen. I like how you did the Josh, even if.
Oh, yeah. Sure.
Let's see.
We got Mark, the financial firefighter, always in the house.
Aloha.
I believe this is Chester.
Good morning, Chester.
We got Josh. We did him. We got Flavio. Oh, we got your boy Angel.
Angel in the house. Love it. Angel's doing some big stuff. He's got like ADUs. Yeah. He's been on it, man. He's a real estate broker. Mm-hmm. He's in the Inland Empire and the greater Southern California, but he's been devout, a part of your community, a part of what we do with the agent investor hybrid and transaction engineering and that. And he has had his foot on the gas. Always his number one goal, whenever we talk about goals, isn't about transactions. It's about how many principal transactions, how many doors, what can he do to expand his portfolio for his family. So great job, Angel.
Killing it. We got Ryan. Ryan's here in the house. Good morning, family. Sarah, always a speaker. She was a speaker at year 2. We got Kenny in the house. Kenny and his wife are helping with the check-in. So that's
Jen. Love it. Yeah. Ken and Jen. I love it.
That's right. They're such good go-givers, which means I get to that's actually one of the hardest things to work on. So I am very appreciative of that. Looks like we got a $5 super chat, I think. Is that how this works? Oh, let's see what this says. I have no idea. Group chat is live. Oh, looks like so I think he did, what is that called? What is this called, Chester? What is it called? Line or something? I don't know. You guys are doing some kind of ORAT group chat. Again, I don't know what it's called, but
it's on an app or it's some
app.
That's called like a Discord, but it's something different. Okay. Like
I'm sure
Telegram or
somebody tell me in the comments. I want to put it on the screen. Oh, WhatsApp. Thanks. See, I knew it would come through. WhatsApp. So I guess WhatsApp.
How do they find it? How do they find it, Chester?
I'm guessing they just go get the app WhatsApp. And then is there a name, Chester, did they search for? Probably just ORAT3, I'm guessing.
ORAT3.
That's probably what this is. Yeah, the ORAT3.
ORAT3 group chat. I love it.
Yeah.
Community.
Yeah.
I love it.
All right. So let's see. We got some questions. Oh, this is fun. When will we start seeing commercial multifamilies listed for sale? These are properties that have commercial loans that are not going to be extended. The answer is it's already happening. I just had a conversation with Jonathan Twomley, who is the commercial guy on my channel. I think that posts on Saturday. And he's like, dude, it's happening. I'm like, what? He goes, it's finally breaking. Yeah. He's starting to see listings. They're starting to age out. He's starting to get phone calls that say the following: what would it take? What would it take?
Yeah.
So again, I would argue that listings are already happening. They're just listed at stupid prices. But when you get brokers calling their trusted advisors and saying, what would it take? What would your offer be? And again, I'll give you some examples. This is from memory. They'll be close. They may not be exact. When you watch the video, you hear it. So he's looking at a hotel. I believe the hotel was listed for $5 million. The hotel has 18% occupancy. It is owned free and clear. So the sellers have, if the sellers are profitable at 18%, you know there's no debt. And they've owned it for years. They want to retire. And the property's been listed for over 300 days, so over a year. And Jonathan's been kicking this, hotel for a long time because he wants it, but he wants it with seller financing, and he doesn't want to pay $5 million. So the broker got back to him yesterday. When was today? Yeah, yesterday's Thursday. So I talked to him Thursday. So yesterday morning, he's 3 hours ahead. He's in New York. He got a call from the broker saying, what would it take?
Yeah.
And you'll hear it in the conversation when Jonathan and I talk. And Jonathan and I were brainstorming what we would offer. And I said, Jonathan, I would write two offers. I would write a cash offer at something stupid like $1 million. So that's an 80% discount, right? And you write stupid offers or disrespectful offers like that, not because you want them to say yes, but because you want to create an anchor, a floor. And then what I told him to do is you should hand them a second offer that says something like $2.5 million, but seller financing, 3% interest, 10-year balloon, no payments for 6 months because we have to escrow funds for remodeling or what. I mean, just get gnarly with it. Right.
Yep.
And that shit's coming. It's just starting. Jonathan and I in past episodes were like, could this extend to 2027? And we're like, God, I don't think so, but maybe. Yeah. But based on my conversation yesterday, he's like, he looked like a Cheshire cat, right? Those big eyes. He's like, I see it. It's finally coming. So I think awesome. It's starting to break. I think this year. I think the answer is 2026 to Lewis's question, and that's one guy's guess.
It's interesting too that even in the 2 to 4 unit stuff.
Yep.
I'm not seeing broken, but what I am seeing is I'm seeing people that were very optimistic.
Yeah.
They bought a duplex and, they got in it. They're living in one side. Maybe they said, okay, this is not for me. They went and bought another single family and they're just not making the money. The income is not what they hope to be. They tried Airbnb. They tried traveling nurses. They've done some of those strategies, midterm, short term, whatever. And they realize it's a lot of work. I'm busy with my other job, with my real career and whatnot. And so I just see where people are realizing that maybe it was over leveraged, those kinds of things. So I'm starting to see a little trickle of that inventory come. And it's interesting too, some of this stuff that's been acquired in the last 3, 4, 5 years during, kind of COVID, post-COVID, a lot of these properties are also in really good shape.
Yeah, they've got updated. Yeah.
Yeah. So they've got the windows and they were done as flips and whatever the case may be. So I just see that some of those, I'm seeing those soften on price, 5, 7, 8%. And, or even maybe some of them I see maybe coming on as short sales. So
yeah, it's again, folks, we're here for questions. You guys want to put questions in, just put them in. We'll stay on for at least another 10 minutes. Otherwise, Ty and I'll just wrap because we're good friends. It is interesting. I mean, one of the things that I told my audience to do God, when did you and I do this? Maybe 3 months ago, 5 months ago, was to start marketing to NODs, right?
Yeah.
Notice of defaults.
Yep.
Because one of the things that I think 26 will bring is I think 2026 is going to be a healing process.
Yeah.
And what does that really mean? That means we just got to clean out the old junk, right? There were some deals that were just bad deals the day they were done.
Right.
And there's been a lot of extend and pretend, a lot of, pray and spray, or, whatever you want to call that. And, part of the system is you got to let people lose. So as we said earlier in multifamily, it seems like that's coming, but I think it's going to happen in single family as well. I think there were some shenanigans going on with FHA and VA loans for too long.
Big time.
Like, they had 4 revisions or whatever they were called. And you just got to foreclose on people sometime. Yeah, it sucks, but you got to clean out the system. So I do think there's going to be opportunity for folks in 2026 to just pick up, whether it's a physical foreclosure, which probably not, but probably a short sale.
Yeah.
Pre-foreclosure, I think you might call it. But yeah, I think 2026 is going to have a lot more opportunity than people realize.
Yeah, it's interesting too. I'm excited to hear what you guys are going to do at 9:00, because even I'm interested, especially too, like what happens for investors, like as an example, the DSCR loans with everything going on in the bond market.
Yep.
How does that affect pricing across the
great
board?
Question. Great question. I don't know. Yeah.
And then even looking at even like non-QM, because I think about like a lot of self-employed people that are contractors, people that are real estate professionals that, typically have a lot of depreciation, not a lot of, bottom line ordinary income. How does that work with non-QM products? So it's interesting. I'm going to definitely be pinging the comments.
Yeah.
With,
you can text me questions.
Convoy.
I will work them in. Yeah.
I love it. I love it. Also too, here's something too that you and I talk about.
Mm-hmm.
There's no crash that's going to happen this year. There was no crash last year. We were basically plus or minus what? We were plus 1% appreciation. What was the actual number for 25?
Well, we don't have it yet. The first company to report the number was ICE. It's the old Black Man. Well, it was a company that got purchased. They reported it up 0.9%. Again, what did I call 1%? So I'll give myself credit for getting it. Certainly not down 38%, not down 9%. All of these crash sisters and brothers are just morons that don't know what's going on. But yeah, it's how can you have a 38% crash in 2026 when you've got the president of the United States saying, I'm going to tackle housing affordability? I mean, come on. It's just like wild.
Let me throw a curveball at you. So I'm getting my hair cut yesterday. Mm-hmm. And this is always good when you hear your hairdresser, that your barber, your hairdresser, they're talking about, she says, hey, we started talking about people moving out of state, out of California. Mm-hmm. And she goes, yeah, man, I heard that like Florida, like the market's crashing there, that people, and it's interesting, but talk about like Austin, Texas. Yeah. I keep hearing about, I have no idea, because I've never even actually went to look. And then you hear about parts of Florida. Mm-hmm. In some markets are soft, like some neighborhoods 3 miles away from me are maybe down 5%, 7%, but then across town, it's up 3% because there's no inventory there. Talk about that whole balance and what markets were soft. And
yeah, I mean, clearly Texas and Florida had a lot of net migration, which caused prices to exceed normal behavior. And I think the peaks in both markets were 2022, maybe early 2023. They're not my market, so I'm just going from memory. But basically, we had a bunch of blue states rushing to red states, and that caused a artificial rise in prices beyond extreme. And at least in Austin, I know that number from peak to trough, it was down 21%. And even I would say that's a crash. Anything over 20% is a crash. So you can absolutely say Austin crashed. But where people get this wrong is if you zoom in a little, Austin's up year on year. Yeah, it's up year on year. I actually have data from Palm Beach County because it was something I talked about earlier in the week right in front of me. Again, Palm Beach County, devastated by a hurricane, lots of problems there. But in November, Transactions were up 19.7%.
Wow.
Again, some people don't realize they're just holding on to the fact that Florida and Texas are bad, and they're not realizing that they're up year on year.
Right.
Right. So when you get the two biggest drags that were pulling things down, and we still posted a positive 0.9 to
Right.
no longer be massive drags, what happens? Right? It's
Yeah.
just math. It's just math.
It's just math. And that's the same thing. And it's interesting because in the Bay Area, if we're in the East Bay, there's certain parts that are close to Silicon Valley that have high school ratings, and those values are solid, maybe even up 2 or 3%, depending on the subdivision. But then you go 25 miles a little further east, bedroom community, a little bit more inventory, and maybe those are soft 2 or 3, 4, 5%, year on year, if you look at subdivision by subdivision. So can we expect in 26 that you're still going to probably see more of that? Some neighborhoods really hot, some neighborhoods soft.
Of course. I mean, that's housing in general.
Yeah.
Again, I think most people, at least most people watching this, they should only care about their buy box. But their buy box may be their city. They probably shouldn't even care about their state. Do I really care about what's going on in LA if I'm buying in the Central Valley? No. Right? Do you care what's going on in Sacramento? Housing? No. Right? I think most people should focus on their buy box A. And if you want, you can go out to the city, but that's it. Yeah. Me as a geek, who's been studying economics for now well over 30 years and housing for 25 years, I geek out on this stuff.
Right.
But I can separate Mike the economist from Mike the real estate investor. Right. When it's Mike the real estate investor, I'm just like everybody else. I just look at my buy box and what's a good deal and what's a great deal and all of that. I can have that split personality. Not everybody. Most people should just ignore national statistics. They're irrelevant for your pursuit of wealth.
There's no crash coming in 26. You're a fool if you even buy into those headlines. I mean, that's the straight answer.
But to your point, could a city fall 20%? Absolutely. I mean, there could be some local regions. Like, I'll give you, for example, to tie in our first part of this conversation. If these are all ifs, but I'm just showing you how it could happen. If President Trump and Congress put into law that institutional investors have to disposition all of their properties in 1 year, Atlanta, Georgia will crash.
Yeah.
Jacksonville, Florida will crash. Why? Because you will get a wave of inventory in a very, very short window and cause prices to crash. Now, do I think they will do that? Of course not. Because anybody with half a brain cell would realize having big sellers, sell in a year is stupid.
Right.
But I've seen government do stupid things. Government does stupid things all the time. So if they are forced to sell everything in a 12-month window, you could count on certain cities getting wrecked.
Yeah.
But again, what would I do? I would go shopping because in 3 years or 4 years, they will just revert to the mean. But there you go.
So let's finish on opportunity. Let's talk about, the thing I'll share and I'll start the conversation. Mm-hmm. What's different in 2026 today, January the 9th, 2026, is that every seller I talk to understands that the housing is not hot. The market is weird. Interest rates are higher. You've got to price right, that it's not this red hot market that was 3 years ago or 2 years ago, or even in 24, we were fighting with sellers trying to explain what's going on. And they just, no, I'm getting lots of calls. Lots of calls doesn't mean the market's hot. Talk about the opportunity. I think that makes it easier for us to go in and find deals. Talk about opportunity and finish on that.
Yeah. So I'm going to divide the year in half. I think you're absolutely right for the first six months, Q1, Q2, the spring selling season. I think what the sellers have learned at the end of Q3 and Q4, and that's why we had record delistings and all of that stuff, is you said it exactly right. Real estate's not hot. Housing is not hot. And that means I think a lot more sellers, if they choose to sell, will be more realistic. However, again, that's why I wanted to divide the year. If Trump is successful, and there's an if there, if he's successful at getting rates down and he does some of these other things that we talked about today, housing might get hot again.
Yeah.
And the second half could be very different than the first half. Again, I want to be clear. I do not want to see real estate values go up. I want real estate to be flat another year.
Same.
I want real estate to be flat for another 5 years. We got the whole decade of appreciation in 2 years. So if we could have 8 years of flat, I would be ecstatic, because we got to get this affordability number back to normal.
Yeah.
And adding even, dude, if we added 3% national home prices in 2026, I think that would be a problem. That would be horrible. Yeah. Even only 3%, it would be horrible, because it's 3% on a freaking nasty big number already. Yeah. And heaven forbid we got 5 or 6. That would be a disaster. It'd be a disaster long term.
Right.
But yeah, it's bad.
Without inventory and doing something in the tax code with capital gains or something, in the end, this demand, if they only focus on demand,
it could be a problem.
It's gonna backslide on affordability, because it's just gonna.
But again, this is why all politicians suck. In my opinion, President Trump is only worried about the midterm elections. The guy's not running for a third term. The guy needs the Senate and the House to do what he wants to do. So Trump is going to scream from his bombastic, whatever, perch, everything he can to win the midterms. And that means he could do things that make housing look affordable, but by 2027, it's a problem. He's going to be like, not my problem. Yeah. Right? That's the next guy's problem. I have some real concerns that we might do more than 1%, but I hope we don't.
Okay. Well, time will tell.
There you go.
Thank God we got you, Michael, doing all this work. And I'm going to have to go back and listen to some bits and pieces of this, because you were talking about things even 5 years doing the show. I'm like, how does that work? So I love what you're talking. I love all the work you do, man. Thank you so much. Folks, 9 a.m., he's going to go live again. They're going to talk all about mortgage. So you want to be on that. Listen to it. Listen to the replay. Get on there. Tickets. Go to Eventbrite. If you're planning to come to Vegas, you've got about 6 days to buy your tickets. Otherwise, on the 15th, they're closing the cart. So get your tickets to Vegas. $299?
Yep. $299.
$299 gets you in the room. For the ballers, I know there's several ballers out there. Upgrade to the VIP. VIP. Anything else, Michael, that you want to close with?
No, this is just fun. I like doing these financial wrap-ups. We actually went 30 minutes longer than normal, which is awesome. Maybe we should make this a routine where we take 30 minutes of questions, and we'll just add that to the session. Who knows?
Folks, let us know if you want to do question, and we'll ping the questions. Even if we do the 30-minute show, we can just say, okay, we'll go faster and do the last 10 minutes.
Yeah, absolutely.
Of questions. So we want to hear from you. Thank you, Michael.
It's our show. We can do what we want. Take care. Later.
Love it. That was fun, man.
Yeah, that's good.